What's up guys, Joshua here. In today's video, I'll be building the perfect investment portfolio. This portfolio, in my ever so humble, coffee drinking, hat wearing opinion, is the best portfolio for anyone between the age of 18 and 50. So if you're between that age and you're looking to start investing but you have no idea where to start, then this video is definitely gonna be for you, and I think that you'll get a lot of value from it. So let's get started. So I'm gonna be breaking down this video into three major parts. In this first part, I wanna just sort of lay some foundation, some groundwork. I'll briefly go over things like the definition of an investment portfolio. We'll talk about risk tolerance as well as assets that make up a portfolio. So for starters, what exactly is an investment portfolio? An investment portfolio in this context is simply a collection of assets, and assets include things like stocks, bonds, REITs, ETFs, index funds, things like that. Now, when you think of an investment portfolio, I don't want you to think of something physical. It's more of a concept that helps you to sort of metaphorically imagine all of your investments under one roof. For example, you might have like 3 different brokerage accounts, okay? But that doesn't mean that you have 3 different investment portfolios. You still just have one investment portfolio, and all of the assets in all 3 brokerage accounts just make up one entire investment portfolio. So if you wanted to start building your own investment portfolio, you would first need to understand the type of investor that you are as well as your risk tolerance, because those 2 things are really going to determine the type of investments that you choose to add to your investment portfolio. For example, if you had a lower risk tolerance or you were more risk averse, it would mean that your portfolio would have more conservative investments. In other words, if you were a conservative investor, then your portfolio would likely have a lot of bonds in it, or like different types of fixed income securities. You may have a few equities or like stocks, and finally you would probably have some cash reserves sitting in like a high yield savings account, or perhaps just at your local bank. And of course, the opposite of a conservative investor would be an investor who is aggressive. If you're an aggressive investor, then your portfolio will likely be super heavy in equities or stocks and perhaps like some real estate. Okay, so now is where the fun actually begins. We're gonna start building the perfect investment portfolio. Now, the portfolio that I'm about to build is gonna be a very aggressive one, because I believe that if you really want to build lasting wealth, that you have to be aggressive, especially if you're still young. There's no point in investing in bonds or other fixed income securities that have super low returns. That just won't cut it. You're young right now, and now is the time to really take advantage of that growth and that compound interest that comes from investing in equities. Bonds will come later in life, when you're much closer to retirement and your investing goals shift from growth to capital preservation. And so for that reason, the portfolio that I'm gonna build today will be 100% stocks. Now, I'm not gonna spend hours and days picking individual stocks, right? I don't have time for that. You probably don't have time for that. Nobody has time for that unless that is your job. But that's not my job, and so I'm not gonna do that. Instead, I'm actually gonna be building my portfolio entirely with funds, specifically ETFs or exchange traded funds. ETFs will allow me to invest in thousands of stocks without having to spend thousands of hours picking and choosing from thousands of different stocks. ETFs will also give my portfolio an amazing level of exposure to different areas of the stock market, which of course will also give my portfolio diversification, which is arguably one of the most important things to building a good portfolio. So let's say that I've got $10,000 to start investing with. What ETFs am I actually going to start buying? But even more importantly, how exactly am I going to allocate my portfolio to ensure that I am maximizing the growth of my investment? Okay, so let's get started. The first ETF that I'm going to buy and add to my portfolio is actually going to be $5,000 or 50% of my money into VTI. VTI is Vanguard's total stock market ETF, and it'll act as a really good foundation to give you really broad exposure over the entire US stock market. This ETF holds about 3,800 US stocks with top holdings in Microsoft, Apple, Amazon, Google, and Facebook. VTI has an average 10-year return of 14.7%, and as you can see here, if you took $10,000 and invested it into VTI 10 years ago, your investment would be worth almost $40,000 today. Now, usually I would have recommended VOO to you over VTI. VOO is Vanguard's S&P 500 ETF, and it tracks the performance of the S&P 500 index. However, if you compare the performance of VOO and VTI, you'll see that the two have nearly identical growth over the last 10 years. But the big difference is that VTI holds over 7 times the amount of stocks that VOO holds, and so by investing in VTI, you'll definitely give your portfolio a lot more diversification over investing in VOO. Okay, so that's 50% of my portfolio that I'm investing into VTI. So the next ETF I want to invest in is 30% or $3,000 into QQQ. Triple Qs is an ETF by Invesco that tracks the NASDAQ 100 index, which is an index that tracks the performance of the 100 strongest performing stocks on the NASDAQ stock exchange. Now, Triple Qs is a very tech-heavy ETF. It's often compared to VGT, which is Vanguard's Information Technology ETF. You can see by scrolling down this list here, by investing in this ETF, your portfolio will be exposed to some of the greatest companies in the world. Triple Qs has an average 10-year return of 20.54%. And honestly, just based off where the world is heading and how technology companies just continue to innovate and push us into the future, I think that this ETF will continue to give really high returns in that 20% range, if not even higher. Okay, so we've got $2,000 left, or about 20% of my total money. So what should I invest in next? So I thought long and hard about this, and I considered just putting the rest of it into VTI and just calling it a day. And you could do that, that would be totally fine. But I personally, for this portfolio, want to add a little bit more exposure to markets outside of the US stock market. And so for that reason, I'm actually going to invest the remaining $2,000 into VXUS. VSUS is Vanguard's total stock ETF, and it seeks to track the performance of companies in developing and emerging markets outside of the US. This ETF holds about 7,576 international stocks, and it has a 10-year average return of about 5.67%. Now, I know what some of you might be thinking. Joshua, 5.67%, that's low. Why would I not just go invest all of my money into VTI and get a 14.7% return? And honestly, you could do that and that would be totally fine. But in this portfolio, in my portfolio, I'm choosing to add some international exposure because contrary to the popular belief that US stocks outperform international stocks, that just isn't true, and it's not really that simple. The real reality is that the performance of international and US stocks is actually cyclical. In other words, one typically outperforms the other over a several-year period before the cycle rotates. You can see this being demonstrated by this overly complex chart right here. The years that US stocks are outperforming, international stocks are underperforming. And the years that international stocks are outperforming, US stocks are underperforming. It's impossible to time the market, and so the easiest thing to do is just sort of create a set it and forget it portfolio where you invest in both US and international stocks and just call it a day. However, after saying that, as you may have noticed in the pie chart to the right of me, my portfolio that I just built is for sure heavily leaning toward US stocks. And if I'm being honest with you, that's because I believe that in the long term, like in the next 100 years, US stocks will outperform international stocks. And so naturally, my portfolio will lean more toward the US economy and US stocks. Or you could just keep things really simple and take advice from one of the greatest investors ever, Warren Buffett, who suggested that normal investors like you and I just put 90% of their money into a low-cost S&P 500 ETF such as VOO or SPY. Investing 90% of your portfolio into VOO or SPY, that could also be considered the perfect investment portfolio in the eyes of many, and I wouldn't argue that. It is very easy to spend hours of your time sorting through all these different funds, trying to figure out the best combination to give you the highest return, but in my experience, that just causes paralysis analysis, and it's going to cause you to not even get started in the first place. And so just ignore all the noise and just stick with something really basic. Ultimately, the most important thing to do is just to get started. The portfolio that we built today is a perfect portfolio, but if you wanted to go even more basic and keep things even more simple, then you would just go like 100% VOO or VTI. Even just doing that would pretty much make you a guaranteed millionaire by the time that you retired if you actually got started soon enough. And if you're not doing this already, remember to take advantage of all the different retirement accounts that are available to you, such as the Roth IRA. The Roth IRA is a completely free investment account that you can open pretty much at any broker that will allow you to build your wealth tax-free. If your employer offers a 401k with matching, you have to take advantage of that. That's free money that you're giving up if you aren't already taking advantage of that. But don't just stop there. Even if you're maxing out all of your retirement accounts each year, you can still open up an individual investment account and put all of your spare money into this account to be invested as well. And by the way, listen, I'm not saying that you shouldn't enjoy life. If you have the extra money to go on vacations or to be generous and to give gifts, then you should definitely do that. But I think that it's also super important that you invest in your future because you only have one chance to do that. That is the biggest mistake that you can make financially, is not investing for your future. And unfortunately, that's something that we're not taught in school. Okay, so enough rambling from me. Hey, listen, do me a huge favor, drop a like on the video below if you got some value from this. Also, if you love finance content, then subscribe to my channel. I post about 3 times a week and everything I post is centered around finance. Plus, I just really love seeing you here, and so I would love to have you back on these videos, okay? So listen, I appreciate you so much for watching, and I will see you again very soon. Take care.